So it appears that the AI is a massive bubble in our markets. And I want to go over some numbers and some charts with you because check this out. This is from the Financial Times today. They say how the AI bubble compares to history. Okay. And US stock valuations are higher than before the 1929 Wall Street crash. Let me read that one more time. US stock valuations are higher than before the 1929 Wall Street crash. And they have some charts here to compare. We're looking at the P/E ratios, so basically price of stocks compared to how much companies actually earn, and also to market cap of the market to GDP, right? And in both situations, it depends, what you want to compare it to, be it the Wall Street crash or dot-com bubble, but at least in both situations here, it's bigger than what happened in 1929, right? When you look at the dot-com bubble, which is kind of interesting, valuations are far more stretched than they are now, but it's pretty similar. They're both very much an elevated sense. And essentially what this is that means the way we're pricing stocks and companies and stuff like that, we're expecting them to make a ton of money, right? Because right now, the price of stocks are disconnected from how much money they actually earn. Many of these AI companies are actually underwater, and they promise you they're going to make money in 2030 or something like that. You never know. You don't know 4 years from now. I want to make that clear. No one knows what's going to happen 4 years from now. But the issue is that they're not profitable now, and these things are power hungry and they're capital intensive, and they keep wanting to build data centers to push everything out. When you read some more details of this stuff, I'll just read a little bit. It says, surging artificial intelligence stocks have driven the U.S. market to record highs this year. Yep. Drawing comparisons on some metrics to infamous periods of investor mania in the past. And we're talking about NVIDIA here, stuff like that. And they were saying AI sector could be in a bubble, and that stock market correction could pose a threat to financial stability. That's why you pay attention to this stuff, I know some people, they're like, oh, why do we care about markets? I'm not in the market at all, right? This stuff matters because, guys, like much of the U.S. economy these days is built on this kind of stuff. We're not really a manufacturing company anymore, right? Basically, you could argue we're a dollar pumping country or a financial country, right? Services, these things, it's a much bigger part of the economy than in the past. You can also look at this. It's interesting when you read through this stuff. It says the U.S. blue chip S&P 500 is now more expensive on a cyclically adjusted 10-year price earnings ratio, right, than it was before the 1929 Wall Street crash, and well above where it was on the eve of the 2008 global financial crisis. So we're trading at really high levels. Here's more. In data going back to the 1840s, the only time valuations have been more stretched has been during the dot-com bubble in 1999. And I lived through the dot-com. I lived through the great financial crisis. If you guys don't know, I'm 50. And so I've seen all this stuff before. I've seen how this game is played. Like everyone's getting excited. You think everything's going to go up forever. It doesn't. It doesn't. Eventually reality catches up with you. And it's interesting because I know people say, well, Chris, AI is so awesome. I use it every day. It's going to, replace all the people. We're all going to be rich. Maybe some people will be okay, right? But what about the people who lose their jobs? And I think that's a real concern. And will AI actually be as productive as you think it's going to be? This is a really interesting chart also. This is basically looking at your consulting firms and the predictions for, AI and productivity. How's that going to help? It says estimates of productivity gains from artificial intelligence vary widely. Okay. So you have different charts here. Annual productivity growth in this percentage points. Global is the green, blue is US, UK is the light blue, and then you got Europe, which is like a teal color. Increase from AI short term. And the short term, I guess, is like under 1% that these various funds are predicting. Increase from AI in the long term. McKinsey's like more the top. They're saying, I guess, 3.4% productivity, right? Goldman Sachs 1.5. Historic growth in this, I guess, is in productivity just in comparison, roughly 1 to 2%, something like that. So maybe, I guess, if you go with McKinsey at the most, aggressive way of rating growth, with AI, maybe we'll gain a percentage more than normal, I guess. I mean, it depends how you want to look at it. I mean, you can see in 1972 to 82, growth was less than 1% in terms of productivity. Certainly, I will say that some people in some sectors may be more productive with this use of these, large language models and, what we're calling AI. But I don't think it's as big as you think it's going to be. And I keep telling you guys, like, a lot of these companies are underwater. Now, some companies, the big ones, do remain profitable, but not necessarily with AI. It's more their market caps are growing, right? So what this chart is showing you is sort of like where the money, is going in terms of stock. Amazon's a big winner. Nvidia, Apple, Microsoft, Alphabet. You can see Tesla's in there if you want to argue that. I'm just looking at numbers. Broadcom, Oracle, Meta, right? Palantir's in this also. But this shows you where it is. And the big issue, though, is what they are trying to really point out with this chart is if you look at the left, that's the technology chart, is how heavy the U.S. economy / market is tech heavy, right? We're not really a manufacturing company anymore. You could argue, like I said, you're more of a financial a country these days. This is more. And it's interesting when you look at all these charts together, and you can pause it if you like, if you want to read these things, but I'm just going through it. It says AI-related investment drove all of U.S. GDP growth in the first half of 2025, okay? So it's something we've talked about before to where Trump likes to brag about GDP or whatever, but a lot of this is building data centers. And in some cases, you could argue we're double counting stuff to where like, hey, NVIDIA gives a company a bunch of money, right? So, okay, there's a financial transaction there. That company then buys stuff from NVIDIA. Hey, there's another financial transaction there. And you basically get this circular financing. And it's not just NVIDIA or whatever. It's multiple companies out there. They're all kind of incestuous in that way. And it's been a big story of the markets. You can see it here. And then you got the essentially spend on data centers. And I guess the bet is that companies will make more money, and we're betting on companies making more money because they're replacing you, and theoretically you're going to be more productive. That's why I show you these numbers here, right? It depends on the industry that you're in, but these are just numbers from McKinsey. The aggressive productivity gains would be about 3.4%. Now, this is also interesting because this compares to other eras, be it the rail mania, which is really fascinating. Railway mania, they're using the UK as an example here. .com bubble, that'd be the US, but I think there are other international companies involved with that. And then the AI boom, which is happening now. It says the surge in AI stocks has followed trends of previous technologies such as railways and internet. Now, it is true, guys. It's totally true. When the internet came out, basically you came out with companies and say, hey, we're going to sell stuff online. We could all see that was the future. And I agree. I totally agree. We buy stuff online today, right? We totally do. But if you remember the days of the .com bubble, if you're old enough, again, I'm 50, so I remember these things. I'll use the example of the browser wars or the search engine wars. There was a lot of companies that didn't survive. Seriously. I remember a time, and I'm just thinking back in my head, there was like one of the companies had a dog mascot. I want to say it's Lycos. If you guys remember, if I'm incorrect on that one, that was a thing. I remember Excite, I think it was another one. Yahoo used to actually be a legitimate, really big, company. That's way back in the day. America Online, I'm just thinking in my head like these old companies. I used to use Netscape browser, which I don't even know what happened to them. I'd have to go back to the history of that one. But, there were things that at the time, like we actually would use, but they didn't survive. And I think this is going to happen to a lot of AI companies. And again, this is showing you, say, the .com bubble, how it went up, went down, right? And some of the ones actually are still in existence, but their stock didn't necessarily recover from the .com bubble. So that would be like an Oracle or an Intel. So right now with the AI boom, we got the going up part, but the question is then, is it going to just go up like this forever? Are you going to like 5x every year in all your stuff? Or is it going to be more similar to, say, Railway Mania showing here the .com bubble? Let me read the historical view of the railway. It's actually really fascinating. So this would be from the UK. This would be a professor there. Gareth Campbell, an economic historian at Queen's University Belfast, said that unlike other asset bubbles, the railway mania was based on, quote, a very tangible technology that would eventually change the entire system of how people travel, right? Railways. Okay, I'm with you so far. At its peak in 1845, hundreds of new lines were proposed, and railway investment reached 6% of UK GDP. Wow. I can totally see it. And you guys know there's families still in today that made a ton of money off of railway. And I don't know the wealthy families in UK. I'm sure there's some famous ones that are in railway, but yeah, sure. But the sector was hit by an economic downturn. Okay. And the realization that new railways connecting smaller towns would fail to ever find enough passengers. That's part's interesting. By 1850, railway stocks had tumbled to 1/3 of their peak, and projects were abandoned in droves. And that's really fascinating. I wonder if that's going to be like your data center kind of thing, because it kind of makes sense. At the time, You're like, man, everyone's, taking the railway to London. Oh, we're all doing that, right? Like that's the future. It's the future, bro. But there's going to be some cities that it's just not profitable and it's just not worth putting all that money into. And yeah, it's true that, say, trains still exist today. Absolutely true. But does it mean everyone's going to use it? Is it going to go everywhere? Is it going to be profitable? Is it going to be a good business venture, right? For everywhere and everyone. And that's kind of what, say, this, for example, Elon Musk will say with his cars. Oh yeah, we're all going to buy 5 robots, right? And we're all going to have these robo taxis, stuff like that. Like that's sort of the, looking at the historic parallel, talking about, say, the railroad thing, it's kind of the same idea. Like everyone's going to use the railway and we're all going to have it in every town. Not necessarily. It just doesn't make economic sense. And you could argue the same thing with AI, where all these companies are like, oh yeah, we're going to fire everyone. And in our consumer-based economy, no one has a job and we're going to have robots, but like, it doesn't make sense, right? It doesn't add up. And so it's always important to learn from history. That's why I'm showing you guys numbers, showing you charts. Here's a bit of a quotes here. It also says, despite the crash, quote, the railways would go on to dominate the stock market. Okay, Campbell said, given the technologies and transformational potential, I think AI is probably similar. Interesting. And it depends how you want to look at this and how long it'll last. You can take a look here. The railways did stay. So there's 2 different versions of this, right? So the railways went up, stayed flat, and the dot-com bubble went up and then went down. And I'll let you guys be the judge of which one you think it is. I'm more on the bubble side. I'm just literally showing you what they say. Because I do see everything. Like, for example, regarding the bubble situation, the Fed, and this is what the Trumpies want, he wants them to keep cutting rates. He wants to put his people in there to keep on cutting, right? And the Fed's like kind of cautious on this, because what we're looking at, and this relates to the AI stuff and everything, is because the Fed's like, okay, are we more concerned about inflation or are we more concerned about jobs? When you ask people at the Fed, and I just read through this stuff, it's like, and this is the minutes, they're really concerned about jobs. And I think this would be different than, say, the railroad situation, to where if I put in a bunch of railways, does that eliminate everyone's job? Maybe it does if you're like in the horses, right? Just for example, but not necessarily the way AI could theoretically, if companies have it their way, replace y'all with robots, be it deliveries, warehousing. I think Amazon could theoretically automate a bunch of stuff. You could see a lot more in restaurants. You could see it with, any sort of white collar jobs in the office. You see it a lot in customer service. So certainly there's possibilities on that stuff, but that is like massive strain on our economy. And I don't know if people are actually thinking this way through, opposed to just thinking about all of the greed. And again, that's just the idea that we're going to replace everyone, which may or may not happen. Who knows? I'm just telling you guys what the technology is designed to do. On top of that, this just came out of Bloomberg just a few minutes ago. Fed survey sees about $220 billion in bill buying over the next 12 months. Long story short, I think they're worried about liquidity. I think that's what it ends up being. The money is drying up. And you kind of see it happening too in Trump's policies, to where they want to basically get the printing going again and get us all borrowing. And they also want to have more deregulation, which removes protections from customers and has more bank mergers. I know I try to put everything in simplest terms, but that's basically what it boils down to. I see this stuff every day, and unfortunately, people don't pay attention to stuff, and this stuff matters a lot to your life. I mean, seriously, really a lot. Headline, Trump's funding cuts put America's consumer watchdog on the brink of collapse. And someone has a protest sign here. $1 spent on the CFPB, so I believe that is the Consumer Finance Protection Board, equals $2.8 or $2.80 back to Americans. Point being, I think it's a good idea, say after the great financial crisis, to have an agency to protect people from getting scammed. I think that's a good idea, to have agencies out there to protect consumers. I think is a big deal. And unfortunately, the way that the Trumpers paint it, well, there's 2 different ways. So one is they'll say, well, we don't need consumer protections. You're holding back innovation, right? Just simple examples. So let's use the example of the railways. What if someone back, a long time ago is like, oh, I just want to destroy everyone's house because railways are more important. That's about innovation, right? And I want to build, railways right next to, your drinking water, because again, innovation. And people are like, whoa, don't mess with my drinking water. Right? You can see how you can play both sides of the coin here. I come from the school that we don't necessarily have to always put money over people or profits over people. I think you can have a balance of both. I want people to have jobs. I don't disagree with that, but I wish people would actually just talk like human beings and care about their fellow human. I know there's a lot of people out there that don't. They just say, Chris, you got to talk about the bottom line. That's the most important thing. But I mean, these kind of things, I think that if, regardless of party, if any politician came out and said, hey, we want to protect you as a consumer, I think people will go for that. And I don't know why we don't talk about this stuff enough, but it is what it is. So that's what they're saying. They wanted to fund the CFPB basically. And then you got this, and this is actually related to our whole system. I'll just read the headline. You'll get the sense. Emboldening activist investors are circling U.S. banks. So basically the Trumpers want to deregulate everything. And I know from regular people, they don't really pay attention to this stuff, but this stuff matters quite a bit. Just imagine it. And they were mentioning various banks where there's deals trying to go through, be it Comerica, Fifth Third Bank, KeyCorp, whatever, just a bunch of regional banks. There is a world out there where these things start consolidating, getting bought up or whatever. And then Trump and his buddies want to have more crypto-based banks and such. And I'll just say this, how does this relate to your life? If you create a situation where you got too big to fail, and for those of you who lived through these great financial crises, you know exactly what I'm talking about. The idea would be, oh, well, these banks are so big, and even they take all of these crazy risks or whatever and had all of these mergers, and when they, take too many risks and they, are on the verge of bankruptcy or whatever, we got to bail them out with our taxpayer dollars, right? We have to, because we can't let our whole system fail. And these are sort of the situations of why life doesn't get better in USA, is like this kind of stuff. I know it's not as fun to talk about as, Trump farted here or Erica Kirk farted over there or whatever, right? That's what most average person wants to talk about. They don't care about banks or that kind of stuff. But I'm telling you guys, don't ignore these things. I know what to say. Like, the money matters. Money matters. I don't know what else to say. I know it's not sexy. I know it's like exciting, but this kind of things, like removing consumer protections, removing deregulation of banks, it turns into a real nightmare. And if you live through the great financial crisis, I'm just using that example because I remember it gets really ugly. It gets really, really ugly. Everything shuts down. No one's hiring these kind of things. And we're all kind of looking at that going into to next year. And I'll just say this, just batten down the hatches, prepare for stormy weather, and don't necessarily think it's going to be sunny all of the time. That's the best way to describe it. So that's my thoughts on this. I appreciate yours, and I'll catch you all in the next video.